morning and welcome everyone to Money Control live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, wishing all the viewers happy Valentine's Day, a day filled with love, warmth all across. But let's start with the basics on the equity markets. Indian equities stare at a gap down start on Valentine Day. Action in mid cap and small caps essentially eyed. PSU 2 expected to be in action for the day. GIFT Nifty indicates a negative start coming in for Indian equities with losses of more than 0.75%. Talk about the overnight action that we've had on Wall Street. While main indices stumbled on Tuesday, Dow Jones posted the biggest one-day percentage drop in nearly 11 months. Talk about the inflation data. US CPI inflation rules out a rate cut in a hurry. Asian markets slammed by CPI shock. Nikkei retreats from 34-year high. Talk about FIIs. Well, they've bought in shares worth around 376 crore. That's a minuscule amount that we're looking at. And DIIs have purchased equities to an extent of 273 odd crores. Well, also do bear in mind, or just a piece of unsolicited advice there, remember the formula, sip and dip. Use every dip from here to add to Nifty ETFs. That's the view coming across from all the experts. The bigger question, however, that you may want to ask is, what about mid caps and small caps from here on? Recent move in railway stocks is an example of mid cap correction. Many mid caps and small caps can see 40 to 50% fall from the current levels as per the consensus. Enough damage has already been done. Mid caps can't keep running just because of the power of money or liquidity, so to speak. Talk about earnings that now we need to watch out for the day. It's got to be an action-packed day. 646 companies. Also the last leg or the last day of the earnings season where we're seeing 646 companies announcing in their December quarter earnings scorecard today, which includes the like of Mahindra & Mahindra, Aditya Birla Fashion and Retail, Crompton Greaves. Along with that, we are also going to be looking at some of the names like Glenmark Pharma, Gujarat State Petronet and Indiabulls Housing Finance. Well, these are some of the names that are expected to be in focus. Of course, Muthoot Finance and NMDC also will be reporting in their numbers today. Now, stocks that are under F&O ban, NALCO has been added to the list. It's already reported in the numbers. Don't expect significant reaction coming on that one. What has been retained is Aditya Birla Fashion and Retail, Ashok Leyland, Aurobindo Pharma, Balrampur Chini, Bandhan Bank, amongst others. What has actually come out is Hindustan Copper. Well, also I'd like to highlight about the month, the Feb month. Dip is not unusual that we've seen. The correction is not really unusual. What really one would like to wait for is March for pre-election rally, if at all, in the election market. Now, if you look at the data, February has been a weak month for Nifty 50 over the years, with the benchmark indices ending the month in red for at least 8 out of the last 13 years. The data is right there on the screen. In other 5 years, Nifty has returns. However, they've been modest around that 1 to 3 odd % in the month of Feb. Historically, Jan to March is a weak quarter for the market, but Feb has been the weakest amongst them over the past few years. Experts say that this could be due to positive sentiment-led buying, which is usually seen during December, which leads to some correction in Jan, spilling over into Feb. Now, according to Rohit Srivastava of India Charts, this seasonal cycle appeared from 2002 onwards, when FIIs essentially became the significant investors in India. The year-end buying ends in December, and then markets cool off in Jan to March. Now, Srivastava also said that the shifting of the budget date to Feb 1 has aligned with this cycle even further. Experts say that markets see a rally in the period of March to May before the central election. Whether this trend will play out or no, that remains to be seen. But let's get going in terms of the strategy for the day, the immediate support and resistance level that you're supposed to look at. And let's go across to Aamar Singh, Senior Vice President at Angelone. Morning there.
Yeah, very good morning.
Aamar, start off with the basics. How are you looking at the day, essentially, both from the market perspective and personally? How is it stacking up?
Yeah, I would say that we've been very clear that the markets aren't going anywhere in a hurry. And that's what we've been seeing over the last many trading sessions with the benchmark indices. Some stocks definitely are defying the laws of gravity, and we are seeing them move up, but we are witnessing some sort of correction and profit booking there as well. So the broad-based, what I see is that the large caps, primarily the heavyweights, there we are seeing a lot of, I would say, tussle because IT continues to remain strong. Reliance continues to remain strong comparatively compared to the HDFC Bank, ICICI Bank, Kotak Mahindra Bank. So these have been the ones who've been really pulling down the index. And if you look at the index, be it the benchmark Nifty or Bank Nifty for the matter, or Sensex, you'll see that more or less it's consolidation. There are a lack of fresh triggers, and also, as you rightly said, the inflation data that came in the US that was higher than expectation, so that recedes the hopes of any early rate cut happening. So markets are actually factoring in all this, and we are seeing some sort of consolidation. Now, coming to the levels for Nifty, I would say anywhere between 21,300, 400, that's a crucial zone of support for Nifty. If that is reached, then I would say 21,000, 21,100, that's a key zone of support because that's from where Nifty had bounced back on 24th of January. So that tells me on the upside, again, we've got resistance around 21,750, 800. So it's more of a trading range. There is clear-cut lack of trend. And also, if you look at the derivatives data, we see that at times we are seeing some long...
Fair point there, Aamar. Let's address the market open right there for you. We'll come across and addressing the derivative data and, of course, Bank Nifty with you, Aamar, in just a jiffy. Well, we are looking at a negative start, just how we anticipated, right? 21,550. A bit above that level, but clearly below that 21,600 mark, with losses to an extent of 0.8% right there on the screen. GIFT Nifty also indicated the start. Well, clearly the market breadth right now is in the favor of declines as compared to advances. Look at the screen. Advances, we're barely looking at number of 465 versus declines there. Bank Nifty also, the cuts are just deeper for Bank Nifty. And if you talk about the mid-cap index, look at that. The index, which was outperformer, also has taken it harder this time around. In early deals, we're looking at losses to an extent of over 1.5% or thereabouts in early deals. Let's talk about the sectoral indices that we have. PSU banks, let's pull that up along with Nifty IT. Well, fair bit of resilience which was coming through Nifty IT also isn't really being lent. It's a bit of worry there. Bank Nifty, PSU banks, beg your pardon, also is looking at some amount of fair bit share of profit booking in line with the frontline indices. Let's talk about pharma. Well, no solace there as well. These sectors which have been rather contributing or witnessing some amount of resilience also have witnessed profit booking in early deals. Let's talk about the consumption story that remains weak. Metal counters essentially, which have done well thus far, also have given in to some amount of selling pressure. Let's pull up top gainers and top losers out there and then go across to Aamar and check with them. BPCL, Apollo Hospitals, along with that Adani Enterprises. These are some of the top gainers that we have on the list. We are also looking at top losers in just a bit. Right now, the Wipro, Infosys, HCL Technology. So clearly it's the bunch of IT names which have dragged the markets lower, along with that TCS, Hero Motocorp, Tech Mahindra. So it's a bunch of IT along with auto, which right now is weighing down on the sentiment. Clearly, financials also participating on the rally. Let's pull up RIL, the index heavyweight, just to see if we are getting some sort of comfort coming in from RIL. Well, Reliance also is witnessing some amount of selling pressure, and clearly that's weighing down on the market sentiment right now. But I would like to highlight Adani Enterprises today because that's one stock that deserves a mention out there. It rather stands out. Jefferies has initiated a buy call on Adani Enterprises with a target price of 3,800. Right now, the stock is working with a level of around 3,200 thereabouts. It's spoken about the India's leading business incubator, having successfully scaled and demerged multiple industry-leading business with new business of airport and green hydrogen. It expects the EBITDA to grow more than 3 times over FY24 to FY28. Also, Moody's has revised in the rating on 4 Adani Group firms, and it's affirmed the ratings on all the 8 firms. Where it's revised the rating is Adani Green Energy Transmission, and Adani Electricity Mumbai. These are 4 of the entities where we're seeing some amount of rating outlook. The action comes week after S&P has upgraded the credit outlook to stable from negative for Adani Ports and Adani Electricities. Now, Jefferies has also initiated a buy rating on Mart with a target price of 3,400, essentially on the stronger balance sheet, the dominant B2B classified business in India. NALCO is another one. Let's pull that up because we saw huge sell-off in Hindalco yesterday, right? 15% was knocked out post earnings, but NALCO revenue is up by 1%, EBITDA is up by 66%. The margins have expanded to 897 basis points, or let's just say 23% as compared to 14%, and net profitability overall has shot up by 84%. So clearly, NALCO is doing well in trade with gains to an extent of more than 2%. For Indiabulls Real Estate, EBITDA losses have actually narrowed down, and it's come down to a number which is smaller, or let's just say 33 crore versus 245 crore. Will be encouraging to see if we can see fair bit of turnaround taking place for Indiabulls Real Estate for the next quarter. In terms of other stocks and news, what really stood out for me is a Sequence Scientific, where the margins have expanded drastically to 6% versus 2%. Techno Electric, which also has seen EBITDA jump of more than 100%, and Senco Gold, which has reported a decent set of numbers coming in from there. But Aamar, coming on this one, your view on now IT stocks? Do you see more losses coming in? Let's talk about Bank Nifty and the strategy one could look at for that index.
Okay, so first talking about IT stocks, we are seeing some sort of profit booking happening. And if I look at the charts of Infosys, so that tells me that the short-term trend now remains, I would say, somewhat consolidation. And on the downside, 1600 should act as a crucial zone of support. Looking at the other major IT stock, TCS is comparatively far better placed as compared to Infosys on the charts. So TCS still looks strong on the positive on the charts. 4200 is an upside resistance. If that is taken out, then we could witness a significant rally towards 4400 levels. On the downside, TCS has got support around 3950, 4000 levels. Now coming to Bank Nifty. See, Bank Nifty, if you look at Bank Nifty, has comparatively a different sort of structure when we compare it with Nifty. But Bank Nifty is very close to its crucial support on the intermediate term trend, long term trend, as well as short term trend. And if we go back and see on 24th of January, it had made a low of 44,489. So 44,500, that's a zone of support. And we are seeing some sort of positive divergence on the daily charts. So what it effectively means is that we could expect some pullback in, I would say, Bank Nifty towards 45,500, 45,600 levels. But that's the range. The level to watch out for on the downside is 44,500. That's a zone. So 44,500 and 45,600. That's the range for Bank Nifty.
You think more downward pressure is expected from here on, Aamar, or markets are finding support at these levels?
Yeah, these levels, markets will find support because if I look at Nifty, there is very good support coming around the 21,400 odd levels. And also, if you look at the major heavyweights in terms of HDFC, so HDFC has breached the 1400 mark and it's currently moving, trading around 1380 levels. So these are somewhere on the downside, 1350, 1360. That's a very strong support zone for HDFC. So what it means is that markets could get some support on the downside.
All right, your top recommendation for the day, Aamar, and we have a very important guest waiting for us at the sideline. Aamar, just top recommendation?
I would say one can look at from the IT space. Wipro is one stock one can definitely look at on buying at the current levels with a stop loss below 480 and a target of 535 in the short term. And the other stock is to look at from the logistics space, and that is Aegis Logistics, buying around the current levels or any pullback towards 390 levels with a stop loss of 367 and a target of 433 on the upside.
All right, Aamar. Thank you so much for those recommendations and your time. We'll just leave it at that. Appreciate your time.
Thank you.
All right, coming up next is an important guest and, of course, a special one on the show, which is, of course, also special for all you viewers out there. Holland, who is the CEO, Avendus Capital Public Markets Alternate Strategies LLP. Morning there, and happy Valentine's Day to you.
And happy Valentine's to you too, Nickey, and to all the viewers.
All right, the losses have just got a little more deeper, Andrew, this time around. Feb month typically is a month which is known for sharp corrections coming through. At least that's the trend that we've pulled out for the last 8 out of 13 years. What's your assessment? Are you looking at a pre-election rally after some amount of correction? How are you going to play markets here on?
Yeah, it's slightly tricky, right? Because you have that kind of expectation about the elections, and obviously I think that will play out, before May. But then again, you've got to look at the near term, which is obviously, what the Fed, the inflation figures last night, and obviously the Fed's going to go on hold now till May or June. So when I think about the kind of banking sector in India, there's pressure all around, right, for the banks on NIMs, and now any kind of hope that the NBFCs would kind of take over that mantle because interest rates are falling has been taken away as well. So you have a large weightage in the Nifty in finance, and if that's not going to move, and it doesn't look as though it's going to be under a lot of pressure, that I don't see the index doing very much in the very short term. So either global helps before the elections, in that kind of run up, but there's no catalyst really now for the markets after the results season to move higher. And I think the pressure is going to remain on the banking sector.
That's precisely what I was coming down to. What do you make out of the banking space right now? We have a couple of brokerages today. At least Jefferies came up with a report on banks and suggested that, it's the phase, the valuation, it spoke about the valuations essentially. How do you look at it? Do you find any solace within the space, or how are you looking at it?
Not really. I've been to a number of conferences that are, happening around town. And obviously a lot of the CEOs of the banks are there to talk. Now, whilst the brokerage are putting a very strong spin on the Indian story, you don't get the same story from the banking sector. So there's something, it's either regulations, it's either the tight liquidity, it's the RBI, really kind of turning the screws a little bit on unsecured loans, which is worrying them. There's something there which is worrying the bankers, because they should be a lot more gung-ho in terms of the economy. So I think the pressure on NIMs for the banks, and obviously with interest rates not moving higher, than NBFCs become a story that can't play out for the time being.
Okay, I wanted to chat exclusively, or let's just say extensively, about the PSU banks. Comparison of PSU bank valuation versus the period that we've seen from 2006 to 12. It's a similar fundamentals, a rising capex cycle. It suggests a re-rating potential of 25 to 30% on PE or PB levels valuation. What do you make out of it? What's your strategy right now, or your view on PSU banks? And within that space, are there any names that you'd like to list given the valuation in the pecking order?
Yeah, I see. I think there's been a bit of rotation within the financial sectors, right? It's been mainly PSU banks which have been doing very well. And then that rotation goes around to NBFCs. So I think, the pressure on PSU banks' NIMs is also going to be there, right? It's not as though it's not. So yes, valuations are lower. So you can make an argument that, they should do well in the near term. But if the whole banking sector is under pressure, then I think I don't think you can really see. There might be relative outperformance, but I don't see as these kind of moves happening until, and I say until, you expect interest rates to fall in India. Now, will the RBI go before the Federal Reserve? I don't think so. So, I think to my mind, the banking sector remains under pressure, including PSU banks, in the very short term. Now, if I take the budget and I take, the RBI governor, the budget was very bond market friendly. We got $30 billion of inflows coming. The government's obviously, less borrowings going into next year. So that should take bond yields down. Now, it's the timing of that. I think that's more of a April, May call than it is a kind of a March call. So that's why I'm a little bit more nervous in the very short term of how the markets can move ahead on a pre-election rally without some of those other triggers coming in to get investors excited that there's a little bit longer term movement in the banking sector, which will show through in earnings going forward.
Okay, what sense are you making of the activity that you've seen, at least the sharp sell-off that we've seen in the mid-cap and the small-cap and the PSU pack put together? Do you think it's more retail or an HNI phenomena which is right now playing out, or you think that's a shift perhaps which is right now moving in the favor of the large caps? What's your assessment?
I'm not sure it's a movement in favour of large caps. I mean, obviously, there's an argument for large caps to do well, which they have. But I think you have to take each and every kind of stock within the mid and small cap as being slightly different. So I suspect what we're seeing is just some profit taking. You've had some fantastic runs in some of these companies. Valuations are stretched beyond your imagination if you're owning them a year ago. So, you can take money off the table and come back again into those favorite stocks, if there's any market correction, and which is what we've been seeing. So, I don't like kind of saying, it's good, it's always healthy to have a market correction. But I said before, Nickey, to you, if you can just consolidate around here, it's not a bad thing for the markets before the next up move, because I think, whenever you look at, a company that's being recommended, you look at the share price graph, it's just been a one-way street upwards. So, some kind of movement down, consolidation, I don't think would be a bad thing at all.
Okay, which are the sectors typically that you think would now be, or now have rather turned attractive given the sort of correction that we've seen? Sure, we've seen fair bit of correction coming in the PSU, be it the railway, be it the defense. We've seen significant correction coming in even those themes per se, which otherwise were doing drastically well for the previous year. What do you think would be in focus from here on, given the sort of correction that we've seen?
Yeah, it's there's not going to be so many themes that you can play in the Indian market, right? So I think the things that we talked about before, Nickey, which is again, railways, defence, renewables. We know that the government and corporates are going to be spending money in these sectors. So you're still at the very early part of a very long runway. So that's a theme that will continue to play. Yes, some of those stocks got overbought, and you've seen some corrections. So always a good time to kind of dip back into them if you hadn't owned them before. And then the other themes, obviously, hospitality, hotels, airlines is going to be one which I don't think is going away from us for a very long time. And premiumization, as we talked before in beverages, again, is a very early part of a long runway of spending by consumers going forward. And the electronic manufacturing sector, because of the PLI by the government, and obviously we're going to start to see a lot of companies move into this sector. It's very early days in terms of domestic growth and export growth for this sector as well. So use these opportunities, I think, when markets fall or liquidities pushing some of the stocks down, to start picking these companies on a longer term view.
What really changes for you with this correction? Are you what themes, what strategy typically now you think has become rather more attractive? That's one. B, I was also chatting with someone, and one of the experts suggested that now with the sectoral rotation, pharma could see what real estate saw in the previous year. Do you concur with that view?
Yeah, pharma has been unloved, shall we say, for quite a bit of time, and the valuations now look more attractive than they have done for some time. So yeah, it's a place to hide when you have these markets, but I'm not sure it's a theme that I want to play over the longer term. I think the ones that we just talked about is where you will see continued capex by government and private companies. So that will be the kind of earnings growth. And again, as the consumer moves up the ladder in terms of what they want to buy, then premiumization is going to take hold in India in a big way over the next 4 to 5 years. So those are themes that I know are going to work with pharma. You always find that there's something wrong with one of the factories somewhere, which brings the share price down, or some drug has a problem, and so forth. So it's a place to hide in the very short term, but I don't think it's a sector that I want to kind of own with a theme to play out over the next 2 to 3 years.
Okay, I'd also want to chat about the other defensive name out there, FMCG. I mean, it's a story which people have forgotten clearly. Much of the pain and rural recovery there, not enough green shoots. Britannia came up with a fairly decent set of numbers when it came to just the volume growth profile of the company. But otherwise, do you think it's the right time to now enter into these stocks? Because these are typically the ones which haven't really participated thus far in any sort of rally. They've not mustered in any gains. Sure, the rural recovery is. Do you see any green shoots coming in for the recovery, both in rural as well as urban areas?
Not right now, Nickey. No, I don't. And therefore, there's no real catalyst for these companies. I mean, the best that you could hope for is, raw materials for them continue to kind of edge lower, which will help the margins. But, the volumes have not been anywhere near what I was hoping for. So again, unless you can see a catalyst for these stocks, and they're all trading on high PEs, it's very difficult to get excited. Yes, again, it's a defensive play if you think markets are falling, so you get relative outperformance. But I don't think you're going to get, you're not going to outperform the market by holding consumer stocks right at this moment. So I would rather, and I think that's the other place, right? I'm sure you're going to ask about IT. Is IT the right, sector to be in? Well, obviously, if you're pushing back interest rate cycle in both the US and obviously in India, then that's just going to push us out another quarter before that recovery starts to come through for the IT companies. So again, you might see a little bit of pressure on the IT companies over the next few weeks, given the outlook for the Fed being on hold a lot longer. Which brings me to the final point on the Fed is in that I'm sure you've noticed, Nickey, that there's been quite a few problems with commercial real estate in the US, and that's one concern that I have is higher for longer interest rates will have some unintended consequences, and possibly in the commercial real estate market, which would be huge.
Within IT space, do you like anything at this point, or you think what's your assessment there?
In IT?
Yes.
No, I think it's. Listen. If I want to be a little bit defensive in a falling market, it's okay. But there's no until I have to take a call in interest rates, Nickey, to really want to kind of buy into the IT sector. And if it's going to be delayed from March to May or June, then obviously there's no catalyst for this sector to move ahead in the very short term. So again, I think going back to Nickey is what I was trying to say is that the market could consolidate maybe around here a little bit lower. It's not a bad thing, given that there's a lot of headwinds in all these sectors, really for the markets not to go higher.
Point well taken, Andrew. We're just going to leave it at that. And thank you for taking out the time and having this conversation right here with us.
My pleasure. Thank you, Nick.
All right. Not really a bad thing that the market has witnessed fair bit of correction, and the consolidation thereafter is what Andrew typically has to say about it. Also a little bullish on the pharma space for now, consumer story, aviation, and these are hotels, some of the bets or some of the sectors that piques its interest at this point of time. But with this, it's a wrap, and goodbye from the entire team who puts this piece together for you. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen, and for rest of the updates, stay tuned into moneycontrol.com and Money Control app.